Welcome back to the show. Joining me this week are Eric Balchunas and James Seyffart. They are the ETF analysts at Bloomberg Intelligence. They've been tracking all the updates with the Spot Bitcoin ETF applications. Thank you so much, both of you, for joining me.
Thanks for having us, Natalie. Happy to be here. Happy to be back.
Great to be here.
Yeah, well, James, you've been on the show, but for those who haven't maybe seen this, I want both of you to give just maybe a summary of your backgrounds and your roles at Bloomberg Intelligence.
Yeah, so I started in the data department right out of school. I was an intern at Bloomberg, and we covered funds, mutual funds, hedge funds, ETFs. The same team. That's where I met Eric, actually, when I joined the team. Eric had been there for a decade or more since then. But Eric went over, he could talk about what he did to start the team, but I joined Eric in 2017 and covered initially commodities, which included cryptos. And then I also split my time with Eric covering ETFs, which is where more of my expertise was. I've since married those two things and become one of the main people covering the crypto and Bitcoin ETF race, obviously. Eric's my boss. I work on Eric's team.
I don't feel like a boss, but I guess I am. I've been at Bloomberg a long time. I'm like a lifer, over 20 years. I started in the PR department, believe it or not, and then went to data, which is a really crazy move, but it was actually good for me. Spent 12, 13 years in data, and then got recruited in research. And before I joined Bloomberg, I had a short stint as a reporter at Institutional Investor. So research, in my opinion, is a kind of a combo of reporting, data, and you got to be your own PR person these days. So kind of using all of the background in this job, but formally now we run a team of about 10 people that do ETF research around the world. We also cover mutual funds. And that's it. It's growing quickly.
Well, I wanted to know, how has the road to this new Spot ETF compared to the other ETFs you guys have tracked? Because a lot of people have been waiting for a Spot Bitcoin ETF for a long time, and there's really been a holdup.
I'll start with this one because I started covering ETFs right around when GLD launched. So in a way, that's it's almost 20 years at this point. And I remember, it was a big deal, but not like this. The reason it was a less big deal is ETFs were still niche at that point. Only a couple issuers were involved. A lot of the asset management industry thought that ETFs would just sort of come and go. It was like, oh, this will be some kind of passing fad. It wasn't until the last 5 years when the flows got big. Like in 2021, ETFs took in almost $1 trillion. And even in 2022, when the market was down, they still took in $600 billion. These are monster feats for a new vehicle. And so now, because the whole world is like ETFs of the future, it's become a bigger deal than GLD, in my opinion, even though there's a lot of parallels. So it's also a one-of-one situation. Never before have it's taken, SPY took 4 years to get through the SEC. That's the first ETF. This is double that plus some. So it's never been this long. It's never involved like such high rungs of government and Wall Street. It's never been a case where many will launch on the same day that do the same thing. We've never seen that. So if you're an ETF nerd, this is like Christmas morning when these launch, because we're going to find out so many things. There's so many subplots. It's just like a fascinating experiment on many levels. But the big thing is ETFs really don't bridge a new asset class once a decade. When the first bond ETF launched, big deal. Obviously, SPY was. For GLD, trying to think of another one. That's really it. Those are, quote, asset classes. So this is, again, once a decade kind of thing. So that's why we're going so nuts with it, with the coverage, even though at the end of the day, this might take up 1-2% of market share. But it's taking up half of our brain power right now because it is such a big story and such a unique occurrence.
Why have ETFs grown so much in the last 5 years?
The ETF wrapper specifically, you can think of it like a technology for people who aren't familiar. So these things, it's the way that they operate is so much more efficient than the way that pretty much everything else operates. What happens is, like with a mutual fund, it's usually the people running the company. It's a typical fund. Investors put money into it and it stays there. But like with an ETF, there's so many other things you can do with it. It brings in a whole bunch of different other pools of capital. You have people on Wall Street, you have hedge funds, you have traders, and then you have grandmas using this for retirement. So like it basically brings everyone together in one specific technology, if you will, one wrapper. And that basically drives costs down because so many people are going to the same pool. And also you're getting the same fees. So right, as a retail investor, for the most case, in mutual funds or hedge funds, the more assets you can provide, the cheaper the fees are for using that fund or something like that. But with an ETF, everyone's in the same standing point. Like if you wanted to buy 1 share or 200 shares, you're paying the same fees, roughly speaking. It might be different costs in transacting there, but for the most part, you're as equivalent. You might, your grandmother's going to get the same experience for the most part as somebody at a hedge fund. So that whole process has, one, driven fees down for end investors, and two, it's just brought a lot of people into the same kind of ecosystem. It's basically brought everyone and amalgamated everyone to the same spot.
Yeah, and let me add 2 things to that. One is what people sometimes, those are all the main ones: low cost, tax efficient, intraday liquidity. Great. As I say, they're fast, good, and cheap. And normally as a customer, you can only get 2 of those 3 things, right? If something's fast and good, it's not cheap. If it's good and fast, I just said that one. If it's good and cheap, it's not fast. You kind of get all 3 with ETFs. That's why they're, doing so well. I equate them to the MP3. The MP3 completely changed music. To me, the mutual fund does feel like the compact disc at this point, and ETFs to me are digital music. They fit. They're on every brokerage account. They're very easy to access. But and that brings up 2 sort of overlooked advantages. One is convenience. And this is missed with the crypto crowd a lot. They're like, well, why do I need the ETF? And I'm like, well, a lot of people just don't want to remember 12 words for the rest of their lives. They're happy to outsource this, just like with GLD. So for the non-true believers, an ETF is a great solution because they can just buy it. It's going to look like a ticker in the rest of their portfolio, which brings me to my other underrated advantage, which is standardization. If you think of the ETF like USB ports or gas pumps, you can go to a gas station anywhere in the country and it's going to fit in your pump, right? It's standardized. With ETFs, they take in all these different things like that are maybe trickier to buy. Treasury bonds, try buying those on your own. Emerging market stocks, local shares, gold, even the S&P 500 stocks. They're liquid, but it's kind of a pain to buy them all and then rebalance them. ETFs take all those different things and make them trade like shares of Microsoft. So they're taxed the same, they look the same, they fit in your portfolio the same. So they've kind of equitized the entire apparatus, and that is underrated as well. So you throw in all those things. I wrote a book on ETFs in 2014, and my first chapter is called The Advantages, and there's 13. I found 13 advantages. We went over about 6 or 7. And for some investors, low cost is everything, like advisors. That's why in the race for the Bitcoin ETF, low cost will matter to certain people. But for other people, like institutions, it's the liquidity and the anonymity, right? For other people, it might be the tax efficiency. So there's definitely different advantages that are used by different people. Maybe like the Swiss Army knife, you don't use all of the different things. And that's that. And what James said, and when everybody using the same actual class of shares, there are no share classes. It's just one. Everybody feeds off each other because the more the retail and traders use it, the more the spreads go down. And so it is interesting that we're in this period where investors from, what's the name of the hedge fund?
Bridgewater,
which is the world's largest hedge fund, and to James's grandmother, using the same exact shares of the same ETF, paying the same fee. So again, this is why we love ETFs and why they've excited us and why, I don't know what color pill it would be, but we were ETF pilled a long time ago, like you'd be orange.
It's time for a quick break to hear these messages from my partners who make this podcast possible. Coin Stories is brought to you by Bitdeer, where the power of Bitcoin mining is at your fingertips. As a publicly traded leader, Bitdeer's global reach and scale means they're everywhere you need them to be, ensuring you're part of the thriving Bitcoin economy. Bitdeer's not just mining, they are industry pioneers, and Bitdeer stands alone as the only vertically integrated, technology-focused Bitcoin mining company. What does that mean? Well, they're not just deploying, but developing the latest tech to make Bitcoin mining more efficient and effective. With the industry's most experienced leadership team, innovation is in their DNA, and it shows, with a quarter of their workforce dedicated to research and development, pushing the boundaries of what's possible in Bitcoin mining. And now they're leveraging years of expertise in data center and cloud management into high-performance computing through a recently announced partnership with NVIDIA. Join Bitdeer in reshaping the world of Bitcoin mining. Learn more at bitdeer.com and explore how they are pioneering the future today. Well, Eric, something I thought was interesting that you said in another interview is that ETFs represented real capitalism, whereas with mutual funds, a lot of people don't know that there are kickbacks. Can you talk a little bit about that?
Yeah, so most of the mutual fund industry was built on paying brokers to put the client in the fund. So if you're a broker back in the day and you had, I don't know, we'll say James's grandmother, since she's our example, she's your client. You would put her in, say, I won't say a name of firm, but like the XYZ mutual fund. That fund would give you 5-6%, but that money comes from grandma, not from you or the mutual fund. So you're using the client's money. You're taking 5% just for the luxury. It's not a luxury of being put in this likely underperforming active fund that on top of that charges 1% a year. So you start adding it up, and this is where my second book I wrote on the Bogle Effect, I give Bogle and Vanguard a lot of credit. They came along and said, this is horseshit. We need to lower fees. The industry is taking 60-70% of all your gains in the 50 years that you invest. You're only getting 40% of the actual returns because these fees eat them all up. So Vanguard came along and demolished that. Now you can get almost everything for free. So you keep all 98%, 99% of all your returns. ETFs were priced to match Vanguard. So the ETF industry was born kind of riffing off of Vanguard. So I think a lot of this is based on Vanguard effect or Bogle effect in terms of bringing these fees down. So you got to credit them. You also got to credit the advisor world. There's a lot of brokers who were taking that kickback who got morally conflicted, especially when they saw Vanguard out there. They're like, honestly, I know this index fund is a way better deal for my client. I can't keep putting them in this fund that I know they'll get way less money when they retire. We're talking they could get half the money, right? I mean, it's not just like, oh, another 10,000. It's half.
Right. So
these advisors were like, at the broker networks they were at, Vanguard wouldn't pay them to be on the platform. So Vanguard wasn't available. So a lot of them left JP Morgan. They left Morgan Stanley and set up what's called independent advisory firms. So RIAs. The RIA movement is leading this charge. So RIAs now count and fee-based advisors. They only take a % of your assets. They don't get kickbacks. So the ETF movement was largely driven by the movement from broker to RIA, or from the commission-based world to the fee-based model. The fee-based model, I think, puts you more shoulder to shoulder with your own clients, because now your money comes from the % of their assets. And so that's gotten a lot of advisors to pick cheaper funds. So if you go anywhere in the world and you want to look at ETF growth, you first have to look at the growth of the broker to advisor movement. Are brokers still getting commission? Is that how they get paid? Or are they getting a percentage of the client assets? The more they shift to that, boom, the more ETF and the Vanguard effect grow. You need that first, to be honest, to see the real growth in ETFs. And in the US, we crush at this. US is way ahead of the rest of the world in this thing, but over time, it should spread across the globe. So I think that's probably the long answer, but that's sort of how we got here to where ETFs are like the big deal.
Wow. Well, and with a Spot Bitcoin ETF, finally RIAs can recommend this asset class to investors. Can you give us a lay of the land? Where are we at? How many applications and how close are we? Is it really any day now?
Yeah. So on December, we heard, and other people have reported, that the SEC basically told all these issuers, fill out their documents are called S1s or prospectuses. They're offering documents, what have you. They said, get us updated with all the feedback we gave you by December 29th. And there's been 11 filers that did this. So there's 11 filers that we're looking at that we think could launch when ultimately they are approved. The dates that I've had circled on my calendar since the beginning of December are January 8th to January 10th. So I'm focused on those dates. So Monday, January 8th through Wednesday, January 10th, where I think we should see approvals. I say should because technically I guess it's possible we won't see those approvals that day. But yeah, we're within a week of the certain date and honestly, we narrowed in on those dates in the beginning of December. We've been saying January 10th is the ultimate deadline since way back in June and July. So this has been months and months of us focused on this.
Before it was cool.
Yeah, before it was cool.
It was hard to be this optimistic. It's easy now. You know that meme of Mel Gibson and like the guy playing Jesus?
Yeah.
James and I, when we hear people like from Goldman, some research guys like, oh, they're probably going to approve a spot ETF. That's like Mel Gibson sort of talking to the actor playing Jesus meme. That's how we feel sometimes, because it's easy now. It was hard back then. I pat ourselves on the back a little bit because there were a lot of times James and I would go offline and be like, should we hold at 75%? And then when we got to 90, it was like, should we hold? And we worked hard behind the scenes and with everything and our legal analysts to hold the line. And I feel like we're vindicated now. Again, we're not totally home free yet. The next thing to watch is the 19B4s coming in. Those will be final. The first final 19B4 we've seen, I think that's ipso facto approval. It's still informal, but it's basically home free. But not until the SEC, I guess, writes their approval, puts it on the website. That's the formal approval. But I mean, my God, we're looking really good. I mean, we're still at 90%, but we're a very optimistic 90%. And now we've got mainstream media, Fox Business and Reuters in particular have done a lot of reporting, and Bloomberg on confirming and using their own sources to find the same thing that we're finding. So that's corroboration. That's also a good sign.
Well, I remember when you upped your odds from 1% to, I think, 50% just because BlackRock filed an application. So can you talk about why BlackRock was such a game changer? I think some people have called it the fourth branch of government. BlackRock was a really big deal, and Larry Fink came out saying that all of a sudden Bitcoin's a flight to quality. So why was that such a big deal?
Yeah, I'll start, James, because I think that's a phrase I use. Although I didn't invent it, someone said it, and it was an article when BlackRock was not employed, but asked by the Treasury to buy bond ETFs during the COVID crisis.
Right.
That's
and they
a
made
big
a killing.
deal. They really helped support the whole market with the government. BlackRock is special. They're the biggest asset manager. Larry Fink is very integrated. A lot of people go in and out of the Treasury and the SEC who work at BlackRock. One guy from BlackRock used to work at the SEC, who was at the SEC meetings on behalf of BlackRock. There's a revolving door, and they're one of those firms. I think PIMCO is probably another one. Anyway, that's a big deal. BlackRock was also illogical. We weren't watching for them. Up at this point, the filers had been mid-tier companies. And BlackRock, this was against type. And so it was the against type nature of their size that we thought, what do they know? Why are they confident? I will say, in the end, we may have overvalued it a little bit, because if BlackRock could get anything they want from the government, in-kind creations and redemptions would be a thing, because they wanted that bad and they didn't get it. So this idea that Larry can just make a call is a little defeated by this. That said, BlackRock coming in was an event that just, I don't know, it's sort of just got everybody going again, and all these filings came in. The real big one was Grayscale. I got to give them credit. So for us, I think we went from 50 to 75 or 90 after, I think Grayscale got us to 90. That was the big one, them winning that court case. Those are the two major catalysts. But then the other one was after Grayscale won the case, and right around the Ether futures launching, we heard back channel that the SEC had actually started reaching out to go over the S1s for the spot ETFs and giving them comments. I think that's when we went from 75 to 90. That's when we were like, okay, this breaks the pattern of radio silence, delay, denial, which we've seen every cycle for 3 cycles for a decade.
Yep.
Them talking was huge. And obviously that proved to be one of the best bellwethers that approval was going to happen, because why bother? Why not just be radio silence, write up your new reason for denial, and then drop it like a bomb on January 10th? The idea that these S1s are now having all of these detailed technical things going in that are addressing SEC concerns is major. And like I said, they worked through the holidays. This is part of the reason that Matrix report seems so from left field. Yeah. I think it'll go down as a very left field call. It would have made more sense in October or September to say this. But after everything we've seen, I'm like, I don't. And the guy says he's just giving his take. He has no actual sourcing.
Yeah.
So, but that was a little
like
odd.
A one-off analyst. Yeah.
Yeah. But man, he drove the market 10%, which is a little crazy. What do you think of that?
I was happy to buy the dip. So actually, that was a relief for me. But James, I don't know if you have anything to add, but I just wanted to ask you guys, is it a typical strategy for the SEC to sort of wait so that they can approve all of the applications at once? And how will they compete?
Yeah. So talking about is a typical strat. Basically, the one to look at right here is the ProShares Bitcoin Futures ETF, BITO. That thing launched. It got $1.5 billion in 2 days. It's the fastest ETF to $1 billion in history. Ironically, it beat out GLD, that gold ETF that Eric has been talking about. So that one had the record since 2003, 2004. So that was impressive. But the problem there was the SEC was a kingmaker. They allowed one ETF issuer to get one ETF out that offered exposure to Bitcoin futures, and they dominated. They got almost all the assets. They definitely have all of the trading volume around these products. And they just didn't want to do that again. So the SEC, since then, we had been hearing from many people that they don't want to be a kingmaker anymore. And we saw that play out with Ethereum futures ETFs. I know you don't care about Ethereum, but if you look at what happened, basically the SEC did everything in their power to not allow one issuer go out before the others. They basically accelerated all this stuff. They did a ton of work leading into a potential government shutdown to basically line everyone up and let all these issuers launch their Ethereum futures ETFs on the same day. So even before that, we thought the SEC was going to do the best they could to align these things. And honestly, the process, the 19B4 process that Eric spoke about, that's a rule change to allow Bitcoin ETFs to trade. That process is different from the futures ETFs. So the fact that it's harder, honestly, to line everyone up under the other process that the futures ETFs go under than it is for the spot ETFs, because they have a lot more levers they can pull and line people up. So we think, yes, it's not usual. This is new. The only time we've ever seen this done is Ethereum futures ETFs, but I don't know if it's going to continue. I think the Ethereum ETFs and the Bitcoin ETFs in this instance are unique in the sense that, as Eric talked about, this is a one-of-one situation. We've never had a decade plus of denials in the SEC. Basically, usually if you're the first to file and the SEC is going to approve it, you get to launch first, which makes sense. But when you've been denying a bunch of people that have spent millions of dollars trying to launch these products, and then all of a sudden you're going to let one person go first, that looks bad. It's anti-competitive. You're basically being a kingmaker. So that is definitely a unique situation going forward. But we do think that's what's going to happen. There's 11 now, as I mentioned, and we think 11 will theoretically get approval. And then it's up to them whether or not they're operationally ready to actually trade on day one.
What James is saying, though, is why Grayscale is such a wild card. Because if you're, and this is where James and I disagree, I think they're going to hold Grayscale back because of the name of fair competition. If you let Grayscale convert on the day one, they come over with $400 million in embedded volume every day. That's top 1%. Like if they were an ETF now, they'd be top 1% most traded, and I think top 2% in assets at 20 billion. I mean, this is big numbers. They'd be a faraway favorite, even with BlackRock in the race, if they launched on day one. Now, it's still possible, and it's also possible if they launch on day one, they aren't able to maintain that, and others catch them. So I'm not saying it's a guarantee they would win the race, but I could see the SEC, if you're thinking we want a fair race, we don't want to play kingmaker. Grayscale is a dilemma. This is a conundrum because they're the ones who sued you. They proved you wrong. You kind of almost in one way are compelled to add them. But on the flip side, well, if we add them, they'll be the biggest ETF probably in this race. They bring a gun to a knife fight. And so this is a fascinating subplot in this whole, race. So 11 potentially, but possible, 8, 9 make it. We don't know.
Yeah, it's really fascinating. A lot of people watching are invested in GBTC. We saw the discount narrow for, the first time in so long. And yet if it doesn't get converted, I could see the price just absolutely tanking. Can you talk a little bit about this race that you are both alluding to? Is there going to be one Bitcoin ETF winner? I think Eric in an interview said there's going to be basically one at the top, a couple in the middle, and everyone else fails.
Yeah, I think, first of all, there's only room for one liquidity king. It's just the way it goes. There's going to be one ETF that just gets most of the organic volume. And once that one is sort of known as the one, more institutions and bigger investors will use it and it'll just grow. It's like a snowball rolling downhill. And they all want to be that one. That's again why this is so fascinating. There can only be one volume beast. That one is set for life. It has immunity from the Vanguard effect. It never has to lower its fees, ever. Because when you're that liquid, people don't really care what you charge because they're going in and out. So GLD to this day is still 40 basis points. That's what it was day one. So you have pricing power, and that is beautiful. GLD is still the third or fourth highest revenue generating ETF. Still, even with many cheap ones in the market. That said, if you look at gold, there is a middle class. There's a 8 or 9 with over 100 million to, I don't know, 20 billion. I think IAU is probably 20 billion. And then there's even some that are like 50 to 100. But then there are a couple that have launched over the years. They're like just total losers and then they liquidate. So I'd look for one liquidity king, one respectable big one that may be on the cheaper side that advisors like who don't care about liquidity. And then like a bunch of middle class that use their own networks. Like even if you aren't the one, you still have your own clients who you know and love, and they'll buy your stuff and you can get a couple 100 million that way. So, and that's all you need to make a living. So if you get over 100 million, you're profitable pretty much. In this case, it could even be lower, maybe 70 million. So once you see that, they're going to hang around. There will be probably one or two sad cases that just can't get anything going, and they'll probably liquidate within a year or two.
Wow.
Yeah.
Wow. So it's you got to
brutal.
get there first. That's
Yeah,
that's why they're so anxious for the SEC to say yes, so that they can get the.
Not only that, but watch for the jockeying ahead of the race, right? We've already seen seed capital, like even Bitwise put blank is planning to put 200 million. I've never seen that in a document. That's unusual, and then they have a commercial with the most interesting man. You've already seen what's the other firm? Hashdex has a commercial out already.
Right.
Then the fees. Invesco is going to give this like free for the first 6 months. Soon you're going to get a set of steak knives. I mean, there could be one that pays you for a little while just to come in, and then it'll charge you. So there's going to be massive jockeying right up until the starting gun. And again, further reason this is fascinating.
Yeah, I saw that the fees are ranging from about 40 to 80 basis points, but how else will they be able to compete to draw in the capital? Because based on what you said earlier about BlackRock, it almost feels like that might be the winner.
Yeah, so this is something that I've been kind of fixated on and figuring things out. They are going to differentiate in different ways. One thing I was talking about this morning is we're probably going to see some of these issuers will just it's going to matter what matters to you, right? Do you want to go with a crypto first company, somebody that's doing nothing but crypto ETFs and focused on that world, focused on Bitcoin, what have you? Or would you just want to use a name like BlackRock or Fidelity, right? So that's going to differentiate things. Also, some of these guys, I can guarantee you, some of these issuers are going to do like essential proof of reserves. Here is our address. You can see that we have the Bitcoin. Whereas some of these bigger guys aren't necessarily going to want to do that. They might think of it as operational security risk, what have you. So you're going to, this whole process is going to be like what Eric just described. I think it's a winner take most, right? There's like one or two at the top that are going to get most of the stuff, but there's plenty of room for multiple other people to eke out a good living offering these products to a certain subset of underlying investors. But again, we have a total of 14 filings. I think Global X is kind of bowed out. So now we're at 13 filings if you include Pando, which is a European ETF issuer. And then you also have 7RCC, which is trying to launch a spot Bitcoin ETF that holds carbon credits, which might help institutions who are worried about risk of ESG stuff for holding Bitcoin. So there's all these different ways that they're going to try to differentiate. And we can keep going down this rabbit hole of predicting where things are going to go. But there's going to be a lot of jockeying. And we're calling it the Cointucky Derby. So jockeying is the perfect word to use here because it's going to be fascinating to watch. Like Eric said in the beginning, we've never had a situation where so many ETFs doing essentially the same exact thing are going to be competing with each other. Like it's not like there's not that much to differentiate on. They're all going to hold spot Bitcoin, and that's what they're going to offer.
Yeah.
And you also notice in the tickers, there's two that I think are going straight for retail: BRRR and HODL. And Van Eck's commercial was also seemingly more retailish, whereas Hashdex and the other ones seem more aimed at boomers. You're also going to see them aiming at different markets. So there's going to be some people aiming for the do-it-yourself retail younger person, and then there'll be some aiming for the sort of golf-playing wealth manager with khakis and who thinks all this is crazy but doesn't want to miss out. Those tickers are much more sober. So I think that's where the bigger money is, though, by the way. So that's why the BlackRocks and Fidelity's tickers look a little more like just like boring. They're going after the sort of more conservative crowd, but that's where the big boy dollars are. The retail direct, I think a lot of those investors probably left after 2021 mania. They're either over it or they're using Coinbase at this point or something. I don't think we're in a retail frenzy like we were. Maybe it'll come back. I don't know. If the price keeps going up, that could create more retail interest. But to me, I think that it's the advisor network that's interesting. And the other thing on where they store the Bitcoin and how they explain that to you, that actually could be interesting. There's an ETF. I think the ticker is SGOL.
Yep.
It stores the gold in Switzerland. because, in 1920 something, FDR confiscated gold in America,
Right.
and bugs times four. I don't know what you call them, like paranoid gold bugs.
Yeah.
They think that the gold could be confiscated. So in Switzerland, they feel like their gold is safer. Then there's one ETF that holds the gold in London, Toronto, and I believe New York. They diversify it. So where it's stored could be a whole thing, a whole subgenre here that strikes up some competition. I just looked, SGO has 2.7 billion. That's a big ETF just saying, oh, we'll do it in Switzerland.
It's time for another quick break to hear these messages from my partners. Next up, Bitcoin 2024, the world's largest Bitcoin conference, is coming to Nashville this year. Come join us for 3 amazing days of keynotes, panels, networking events, and my Women of Bitcoin brunch. The Bitcoin conference is where I launched my podcast almost 3 years ago. You never know what can happen or who you can meet here. Head to b.tc/conference and use the code HODL, HODL, for 10% off. Next up, CrowdHealth. Health insurance costs are sky high, and it's money that feels wasted if you don't need a doctor. By crowdfunding healthcare with other Bitcoiners, I get to avoid traditional insurance fees and support real people instead of mega corporations. CrowdHealth also works to reduce your medical bills, so the community's contributions cover more. Imagine spending just $100 a month on healthcare and investing the rest in Bitcoin. If you're interested, visit joincrowdhealth.com/Natalie. All right, back to the show. Well, you bring up a really interesting point. I mean, it feels like the government has almost picked a winner in terms of the custodian, which is Coinbase, which ironically is in legal battles with the SEC. Can you talk a little bit about that? And let's maybe dig into the logistics of how these ETFs are going to work with the creation redemption process. Maybe later on we'll talk about in-kind and cash, but let's kind of simplify it a little bit. First, the custody component, because I know that the SEC has been really concerned about that. And it feels like, honestly, before all of the positive activity in this area, they had to bring in a lot of the exchanges that were offshore into compliance, right? We saw Binance, we saw FTX. And so now I feel like they have the argument in place where they are able to make sure they're monitoring for no manipulation of the market, right? And that was one of their biggest concerns and why they denied these ETFs in the past. But can you just talk a little bit about the custodian and then the creation redemption process of the actual ETF shares?
Yeah, so like I said, we're looking at 11. 8 of those 11 have Coinbase as their custodian. So the custodian is basically who's going to hold those keys for that Bitcoin, right? And they're very institutionalized at this point. They're probably multi-sig. Who knows exactly what they're doing? It's proprietary, honestly, probably in the back end. So 8 are using Coinbase. Van Eck is using Gemini. Hashdex will be using BitGo, and then Fidelity will be using their own subsidiary. They'll be using Fidelity Digital Services to hold their Bitcoin, which is interesting because Fidelity, that means it's like very vertically integrated, right? Like the 2 biggest backends for advisors that we keep talking about, it used to be 3. It used to be Schwab, TD Ameritrade, and Fidelity. But Schwab has now acquired TD Ameritrade, so they're the biggest. I think they're bigger than Fidelity, but Fidelity is the second biggest. So like they not only do they have the custodian, not only the asset manager, not only do they have a platform where you can go on and just buy these things directly through Fidelity, they also have the back end infrastructure for advisors to hold this asset. So it'll be interesting to watch them. So basically, that's where the Bitcoin is going to be custodied and held. I honestly think it will be only a matter of time before we see like what Eric was talking about, where he said the gold ETF, they held it, some in London, some in Toronto, some in New York. I think you're going to see a bunch of these ETFs have multiple custodians and then potentially multiple wallets within those custodians to kind of diversify things. So we're going to see a bunch of differentiation on that front, on who's actually holding this underlying Bitcoin. So you asked about the creation redemption process. First, I want to say, like, which I feel like a broken record because I keep saying this, but to like 90% of people, maybe even more, 99% of people, they wouldn't even notice whether or not the ETF is cash create or in-kind create. What this means is though, so well, we can talk a little bit about what's called an authorized participant. But the reason ETF is a super efficient vehicle is because at any point you can theoretically exchange the underlying asset for shares of the ETF, which means that those two assets are always going to be equal because you can always exchange them. So if at any point, like the ETF shares become more expensive or Bitcoin becomes more expensive, they're equal. So that's an arbitrage opportunity, which means you can just exchange them for the other. So you short the more expensive one and buy the cheaper one, and all of a sudden you make free profit because you can always exchange them for the other. The people that facilitate that are known as authorized participants, and they're the ones that actually do the creation and redemption. The SEC is not comfortable for whatever reason. There's a whole bunch of host of reasons that we've heard why the SEC is not comfortable with in-kind creation redemption, which is, in this case, the authorized participants, the market makers, the Wall Street banks and brokers and traders would be handing over Bitcoin and in return getting shares of the ETF to then deliver to the end customer. In this case, they're saying you cannot do that. We don't want you touching the actual Bitcoin. You have to do cash create, which there are like 300, almost 400 ETFs in the US that operate on cash create now. So it's not like something that's never been done. It is unique that they're doing it for a commodity ETF. Like I don't agree with this decision, but to be quite frank, like for the 99% of people, like they won't even notice a difference. It adds a little steps. But what this does do is means that these issuers are going to be the ones, these funds are going to be the ones that have to execute the transactions of Bitcoin. So typically these fund issuers, they worry about marketing and operating the fund and all these contracts. They're not worried about buying the underlying asset because it's just handed to them. And then they give back shares and vice versa. In this case, the fund companies are going to have trading desks. They're going to have to execute either buying or selling Bitcoin, depending on if there's money flowing in or flowing out. So that'll be interesting to watch. But again, for most people, the fact that their SEC is only comfortable with that cash creation process, it's not going to make a difference because that arbitrage mechanism is still there. You're always the value of the underlying shares are always going to be able to be met with the price as long as the ETF is trading.
Yeah, and two more things on that. There are 450 cash creation only ETFs already out on the market. And the ones that have a lot of secondary volume, like they trade a lot on the exchange, their spreads are tight. They're very comparable to regular in-kind ETFs. The ones that trade less have wider spreads. So this is also why getting volume is important. I think the spreads I think are probably going to be more of a function of which ones get the most volume. So look for tighter spreads in the most traded ones, and maybe the spread's a little wider. But I don't think people notice. And the other reason in-kind is really great is for tax reasons. But according to several people we've spoken to, although I can't say I'm 100% on this, the tax issue won't be a problem. I won't go into the details because it's just too boring and it's plumbing. But one of the two big problems with cash creation is gone, if this is true. So that's not bad. So otherwise, the tax issue would be more of an issue. Just one quick thing for your listeners out there who are like falling asleep or confused. I used to teach classes to new hires at Bloomberg on ETFs, and every time I went over creation redemption, they'd all give me poor marks for that section. So I switched my tactic, and I just told the quick story of the guy who started the first ETF, and this will help everybody a lot understand exactly how ETFs work. The guy who started the ETF used to run a commodities warehouse. Picture a warehouse full of different commodities. Picture a big locker full of soybean oil. And the warehouse concept was, if you wanted to trade commodities, it's easy. It's hard to move all the physical commodities. So what this concept was, I take my soybean oil that I don't need right now. I put it in a locker. I get a receipt. I can trade the receipt with other people for a long time. And if I need soybean oil, I can take those receipts, go back to the locker, and get my soybean. So if you want to create new receipts, that's what APs do. They bring the underlying to the locker. All he did was say, instead of soybean oil, let's make it the S&P 500 stocks, or let's make it the bonds in the aggregate bond index. So the locker is the custodian. So that's all this is. And the APs are the intermediaries between the way the receipts trade on the exchange and the locker. And that's why the APs, but whether the locker, the commodities warehouse, buys the soybean for you and gives you cash back, again, tiny plumbing issue, but the same concept exists. Your ETF shares are receipts to deposited Bitcoin in that locker. This is something that's missed because the word cash creation has a lot of the crypto people thinking it's like fake or something, or like, I don't know, they're just going to issue these receipts with nothing backing it. But the fact is, if an AP creates new shares, that cash they buy the Bitcoin, put it right in the custodian. ETFs are receipts. They're not derivatives. And so this is an important concept. And one of the reasons that advisors and the golf playing wealth managers trust them so much over using futures, because remember, ETFs compete with mutual funds, but they also compete with futures and other derivatives, which have counterparty risk. So anyway, just trying to explain and isolate why APs and the creation redemption is an important part of all this.
No, I think that's important. Talking about the receipts, the only thing that people obviously are aware of, especially in the Bitcoin community, is you can't self-custody these ETF shares the way you can do with actual spot Bitcoin. Why do you think the SEC has been so against the in-kind redemptions?
Yeah, so there's a multitude of reasons, right? Like we can, first of all, SAB 121 doesn't let these banks hold Bitcoin, right? There's all these restrictions on what banks and brokers can actually do with Bitcoin. So that the SEC basically isn't comfortable with these people touching it. There's a process that's been set up that basically is like a loophole around those brokers actually touching the Bitcoin. But that loophole, one, is like kind of like the SEC's green lighting a loophole to something that they're not comfortable with. So that just doesn't look great, right? Like, yeah, there's a way that we know will work and will be efficient in operating in kind. But then the SEC's green lighting a loophole that basically takes them out of the SEC's like area of coverage, like what they own. They fully cover the ETF issuers, right? So anything the ETF issuers do is under the SEC's jurisdiction. The other thing that people are talking about is the SEC is concerned about AML, anti-money laundering laws, and know your customer KYC. So they're worried that market makers and these APs aren't going to do enough work to do KYC and AML and where this Bitcoin is coming from, and they want the issuers to actually do this. So I think ultimately we will get to in-kind. The SEC is probably going to have to come up with some rules for these brokers and traders on how to handle this. It's very boring stuff, but the SEC, like Eric said before, BlackRock, Grayscale, these guys were pushing really hard to allow in kind because it is a more efficient process and allows for more things to happen. But that the SEC just isn't comfortable with it.
Were you guys surprised when JP Morgan was named one of the authorized participants, given what Jamie Dimon recently said when being grilled by Elizabeth Warren about this space?
Yeah, I mean, this is like watch what they do, not what they say. Like, there's no way that JP Morgan signed on to be an authorized participant on these things without JP Morgan, without Jamie Dimon's sign off. So that said, also it's cash create now, so they don't actually have to touch the underlying Bitcoin. So this is just them operating transactions in the market and making money on the spreads and the creation redemption fees to actually facilitate those ETF share creations and redemptions.
And honestly, I think JP Morgan was surprising to me. I was expecting to see Jane Street and Virtu almost the whole time in these. Mm-hmm. It's a good sign though. And then I just saw Goldman was interested in working with Grayscale. If you get these big banks interested to be APs more and more, it's better. It just will create more cost compression on the spread. So I think that was a big question mark, whether the big banks would get involved. So even though Jamie Dimon said that, JP Morgan actually is helping this this process by jumping in and being there along with Jane Street and Virtu, in my opinion. So if you see Goldman jump in, and why not? I mean, I think it's not going away. And BlackRock and Fidelity, I think, have given a lot of coverage, or what's the word I'm looking for? Cover for not only people like JP Morgan to get involved, but also the advisors, the wealth managers. If it was just nothing against Van Eck or ARK, but it was just those companies, you might not see the potential. But with a BlackRock and Fidelity, these are historic companies that are, just have massively good reputations and they're already customers of. These are, if a Fidelity or BlackRock fund shows up on a client statement, the advisor has nothing to worry about. Like, you can't get fired for owning these funds, right? These are very, very quality areas. So I think that's also why, going back to the BlackRock, that was such a huge thing, was that they were going to legitimize the space in a way that few other companies could. And Fidelity I'd throw in there as well. So, and this legitimization, I think, is a bigger trend. I think the ETFs are part of a larger trend of what we call like the adults are here. That's what I think BlackRock's ad should be. If they run an ad, it should just be the adults have arrived. Because the crypto people are doing, we're crypto people, not like those Wall Street opportunists. But I think the big companies should be like, the adults are here. It's okay. Like, we're not going to like run off with your money. We're not going to blow it. I think that's sort of the bigger thing going on in general, is TradFi coming into the crypto space, almost like the adults are here. We're gonna clean this place up and make it safer for all of the sort of more conservative investors out there.
I do think that every institution, as well as every individual investor, is going to have some part of their portfolio allocated to Bitcoin and Bitcoin in the Treasury reserves. Let's talk a little bit more about seeding the fund, because obviously we know Grayscale already has a ton of Bitcoin if and when they convert. But these other companies you mentioned earlier, BlackRock, I think said only $10 million to seed the fund. I don't really believe that. Another one came out, I think it was maybe Invesco or VanEck, saying $200 million to seed the fund. So how does it work? They literally can't buy the Spot Bitcoin ETF or Spot Bitcoin yet to seed the fund, which to me, that would mean that if and when they get approved, that's going to be a lot of buying pressure on Bitcoin.
Yeah. So part of the thing here is because it's cash create, that means they have to actually buy the Bitcoin within the trust wrapper, as far as I'm aware. The other thing I would say is people are a little too fixated on the seed, because they could have the seed document, right? So they launch, and these funds need to have some sort of assets in there. So BlackRock, like you said, is at 10 million right now. So they're going to have $10 million of Bitcoin theoretically when this thing launches. That doesn't stop them from having another. They've done this with ESG ETFs in the past, right? They seed with some lower number and then they pour billions in a day or two later. So I'm not saying that's likely to happen. I'm not saying that BlackRock has $10 billion in waiting in the wings, but they could theoretically, some of these issuers could have a bunch of money waiting in the wings to go in day one or day two. And for the most part, people usually don't care about the seed of an ETF, but people do care about day one, day two flows, assets. It'll drive volume, and anything you can do to kind of juice those numbers, like Eric was talking about, to become the liquidity leader, the asset leader from an early point of view, whether it's marketing or funneling assets into here, could be a long-term beneficial for these guys. But yeah, Bitwise is the one that has up to 200 million in their document. Everyone else is much lower, but there's, like I said, there's no guarantee that they don't have clients with assets waiting in the wings to go in day one or something like that.
So just to clarify, have these issuers been buying Spot Bitcoin leading up to this? Is that maybe one of the reasons why the price has gone up? And could this be a buy the rumor, sell the news situation?
So as far as I'm aware, no. I mean, theoretically, so like BlackRock has this private trust. Our view for a long time, when we thought in kind was going to be allowed, they have a private trust with a few $100 million in assets in it that hold exposure to Bitcoin. So theoretically, yes, BlackRock had clients that were buying Bitcoin, and we thought they were going to use those assets. If you can do in kind, they can basically port that, get rid of the trust, and put all that money into an ETF. But for the most part, these guys, they're not going to be buying Bitcoin and holding this exposure like over longer periods of time, right? They're going to do it a day or two before they ultimately list. So for example, again, going back to Ethereum futures ETFs, they listed on Monday. I know for a fact a bunch of the issuers bought the Ethereum futures on Friday, but it's not like they had Ethereum futures sitting and waiting in this trust for weeks before they launch. Like, they're going to have to buy a day or two before the launch.
Do you see this moving the number up pretty dramatically? And earlier we were talking about the fees. I mean, 40 to 80 basis points doesn't sound like a lot, but if there are billions of inflows, they're going to make a lot of money, these issuers.
Yeah, I mean, this is part of why BlackRock got involved, I think. We were always like, what do they know? But then it was like, why do they care? And we found that in the annual report, Larry Fink talked about these new areas of growth. And an ETF, if you're the one, you're looking at a top 5 or 10 revenue generating ETF, depending on where BlackRock prices it. But let's say BlackRock is modest at 40 basis points, like GLD. I mean, this could be a revenue generator for a long time. And remember, ESG did not work out for them. This was one of their big initiatives. It's kind of, I can't say it totally is extinct or anything, but it was a flop. Had a good 2 years, then energy stocks went up and made everybody realize that ESG is active and you can actually underperform. And so even BlackRock pulled out of their own ESG fund. So I think BlackRock is a company that's publicly traded, so they have a ticker, and they have to keep up revenue, because they've got shareholders who are different than their investors. Those shareholders want revenue. So they've got to find new ways to generate revenue, because selling broad-based ETFs and competing with Vanguard doesn't make much money. Like I said, Vanguard has priced almost everything down to zero. And Bitcoin is what we call a VFZ, a Vanguard-free zone. Vanguard is not going to get in here, at least for the next 5 or 10 years. This is not their thing. They don't do commodities really. And it's just not Vanguardian to do this. So you're going to be able to keep prices up a little better than if Vanguard were involved. So for BlackRock, in terms of their interest in Bitcoin as a whole, I don't know exactly how truly they believe it. Probably they do. But there's definitely a business reason for them to do it. And I think that's, at the end of the day, as we like look back, that's probably what sparked their filing, to be honest with you. They probably also saw the Grayscale case and said, let's throw this out there like a call option. If Grayscale wins, they might have to approve and we'll be right there. So that in the end, we actually got into theories where Larry Fink was going to withhold giving Democrats money if they didn't approve it. And that's all not true. But because we were theorizing, why would they do this? So we went down a bunch of different tinfoil hat rabbit holes on this. But in the end, I think the real motive was just, look, we're publicly traded. Vanguard, we keep fighting with, our beta ETFs don't make a lot of money. We need to keep finding new ways to grow our business. Yeah. And this looks like a growth area. And I think they see it in their eyes as a win-win. They can make revenue while at the same time making it cheaper for the actual end investor.
Yeah.
Because they will disintermediate the exchanges to a degree. By the ETF will trade at 1 basis point spread. I mean, that's really cheap to trade. And if they come in around 40 bips, it's just not that much, especially per day, to pay for them to do all that whole, the custody and all the work around storing Bitcoin. So I think they see that as a win-win from their eyes.
Michael Saylor said that this Spot Bitcoin ETF would be the biggest development on Wall Street in 30 years since the launch of SPY. Would you guys agree?
That's probably a little strong and hyperbolic, I guess I would say. But I mean, like we think this could be 1 to 2% of ETF assets. ETF assets, what is it? We're over 7, right? We're at like 7.5 trillion.
We have 8 trillion. So 80 billion would be 1%. That's about where we land after 5 years.
That's our thought. So like this, so it's, I don't,
biggest, it's a bit much. Now, let's just say there's like some major world event that we don't know the future. If there's an event where Bitcoin becomes like, it just rises and it elevates, maybe we could look back in 20 years and this guy could have called it. In the short and medium term, though, I don't see it as that big of a deal. Again, I see it as a big deal, but in relation to stocks and bonds, and listen, I got to say one thing about Bitcoin and the investors and everything. You're probably not going to hear this. Bitcoin is only worth what someone else will pay for it. It's a commodity. And the crypto people, and I sometimes find crypto people kind of crapping on like the S&P 500. I'm like, listen, stocks will always rule as the biggest investment. Because when you invest in a company, you don't just get what someone else will pay for it. That is true. People get up every day, go to work, and they create value in these companies. They sell stuff, they innovate. That translates into earnings growth and a dividend. That's investment return you don't get with a commodity. So even if there's no speculative return over 10 years, the price will go up. You will get money back in return. Bonds give you a coupon. So again, they still think the 60-40, the stock and bond portfolio is going to continue to take up the big part of the portfolio because of the work your money does for you. So in the end, I don't see how it could be the biggest thing ever when I just don't see Bitcoin competing with those massive asset classes that actually you get a little more of a surefire return on your money. Bitcoin, I think, is more of a hot sauce bucket item to cure your FOMO, just in case everything goes crazy and Bitcoin matters in the future, just so I don't feel FOMO. It could be an alternative at some point too and compete with gold. So it's here to stay. It's clearly survived like 10 times it should go away. But that difference between stocks, bonds, and Bitcoin is underrated in the crypto community, in my opinion, and why I don't think it'll ever be the full portfolio. And if someone were younger and we're like, oh, it's my whole life, my whole portfolio, I'm like, that would scare me.
Really? Well, yeah. I will respectfully.
I'd be scared for their retirement.
I will respectfully disagree. I actually think it's going to eat more and more into equities as well as bonds. Value over the long term tends to flow to the hardest form of money, and that is Bitcoin. But we'll let people argue this out on your Twitter feed when I post this. Any final thoughts from both of you? I know so many people have been following your work. Thank you for just all the diligence and all the updates that you've provided so thoughtfully, because a lot of people are tracking this, whether they're for it or against it. Some people obviously in the space don't want Wall Street to come in. Others are very excited about this because because they think adoption is going to really soar. So final thoughts from both of you.
Yeah, I'll say two things. One, what Eric just spoke about is why Vanguard will not enter this anytime soon. That's the reason they don't have a gold ETF, because they're all about cash flows and cash on cash return type stuff. So that is one thing I would say. The other thing I would say is, for the most part, what I view Bitcoin as is a portfolio diversifier, and the historical analysis of what Bitcoin does to a portfolio, even at a 2%, 3% allocation, 5% allocation, is dramatic to the Sharpe ratio. Obviously, past returns not indicative of future returns, what have you, but I think that's what advisors are going to look at, and that's what advisors are likely to do for the most part in aggregate in the space. Obviously, there's some people that are more like you that are going to be strong believers in Bitcoin as the hardest money on earth and what have you, but for the most part, the general population is going to use it for that process, right? The putting in 2%, 5% of their net worth into these things potentially, and not everyone's going to do that. And then the second thing to close out goes on what you were just talking about is, yes, the Bitcoin ETF goes against a bit of the ethos of Bitcoin. Actually, it kind of completely goes against it. But what it doesn't do is change anything about Bitcoin itself. And I think it goes back to what we were talking about in the beginning. ETFs make things very convenient, right? They democratize investing. So for the most part, like, I understand right now the UX and UI using crypto, like, I'm sure other people listen to this, they've sent stuff on any sort of blockchain, particularly Bitcoin, and their heart sinks for a few minutes while they wait to see if the transaction went through, went to the right place. Because I know for a fact I've done it. And my mother and grandparents are just never going to do that, right? So if they just want access to the asset class, this is going to do, it's only a net positive, right? I view it only as a net positive, because worst comes to worst, it's people buying and putting more Bitcoin in cold storage, and that's less supply that's trading theoretically. But also it could bring more people into the ecosystem because they're like, oh, what is this part of my portfolio my advisor put me in? I need to learn more about this, things like that. So I think it's just a net positive. Don't underestimate the convenience of clicking buy and putting this thing on the traditional financial rails in the most efficient way possible. So that's the way I would look at it. Obviously, if you want to be self-sovereign and you want to hold your own Bitcoin in a cold wallet, I'm not going to say don't do that. I'm just saying there are other people that are likely just never going to do that based on what's currently available because of all the issues and concerns with user interface and things like that. So like Eric said, people don't want to worry about memorizing 12 words and keeping that forever. And plenty of people do, and I think plenty of people will continue to do that. I just don't think the ETF is going to like take away from that. It's an end function, not an or function.
Well,
I got into this long reply war with this guy who was like the 12 words thing, and I'm like, dude, I don't even know my Amazon password. Like, thank God it comes up automatically, because I couldn't tell you what it is. And that's my Amazon password, right? You're asking me to ask 12 for the rest of my life. No thanks.
Well, if Amazon held your whole net worth, you might remember that password, right? You might be a little bit more careful about how you
It's a good point, but still, I mean, shit happens, man. I mean, life is intense. I mean, there's a lot of other things to worry about. So, by the way, I see. Oh, the number behind you is the price of Bitcoin?
Yes.
It said 7,000
Bitcoin clock
a second ago.
Among other things. Yeah, we've got hash rate, we've got block height.
Oh, okay.
Got the price right now. Yeah.
And by the way, you're not into Ether, huh?
No.
I end up on these podcasts, and there's some people who accept everything. There's some Bitcoin people. And then one time I was on this Ether podcast, I didn't realize until halfway through. I'm like, these guys are really only about Ether. It's interesting.
I don't judge what people put in their portfolios. I believe in a free market. I just think everyone will end up at the conclusion I did, which is that Bitcoin is the best. Any final thoughts, Eric, before we sign off?
No, it's been great getting to know the sort of other world, and it's been a great opportunity for me and James to sort of be ETF explainers to people and educate people on all this process. We've learned a couple things along the way. A lot of this is very, very detailed legal stuff. So it's been a fun journey, and and if anybody, my DMs are open if anybody has any questions or any hot tips.
Yeah, I will be linking your work in the show notes as well as your Twitter X handles. Thank you so much for all the time. I hope that this process of analyzing the Spot Bitcoin ETF market, that you've both been sufficiently orange-pilled. That's my hope. And we hope to see you next time.
Thanks for having us.
Thank you, Natalie. It was great.
Thank you so much for checking out this episode of the Coin Stories podcast brought to you by Bitdeer. Make sure you're subscribed so you don't miss out on any new content. This show is for educational and entertainment purposes only. Nothing should constitute as official investment advice, and you should always do your own research. My inbox is open if you want to share feedback or guest suggestions. You can reach me at natalie@talkingbitcoin.com. I'll see you next time.